to tell you about a stock that's up 74% in 1 year and it's UK listed. You're probably assuming I'm talking about a racy tech stock or something with a similarly high valuation. Well, that's where you'd be wrong, because it's a good old-fashioned retailer. Currys is one of few survivors in the British retail space and has actually been around for over 150 years, having been founded in 1884. In its current form, Currys plc has 708 stores in 6 countries and has been a listed company since 1927. But, and this is why we're talking about it today, it hasn't had the smoothest of recent histories. Its recent share price rise must be seen in the context of a prolonged period of share price decline. This makes Currys a recovery play. But is there still value to be had, even after a strong share price recovery in the last few years? After the pandemic, during which, of course, we were all upgrading our tech because we were working from home and trying to stay sane during lockdown, demand for electrical goods suddenly dropped. Consumer spending as a whole was down in 2022 and 2023 due to soaring inflation and interest rates. Remember those fun times? This particularly hit categories such as TV and computing, Currys' bread and butter. And the pain of lower sales was worsened by the fact they were also achieving lower margins. This was mainly due to their competitors aggressively discounting their items so as to clear stock. And so in order to stay competitive, Currys and their Nordic business Elkjob also had to slash their prices. So lower sales volumes and lower prices started to cause a problem for the business. Currys also had a large amount of debt on their balance sheet, which hadn't been too much of an issue until 2022, when interest rates went through the roof, and all of a sudden, the cost to service this debt also skyrocketed. Add to that a hefty pension deficit that was costing them as much as 60 to 80 million pounds a year in contributions. The company's cash flows were severely impaired. These factors contributed towards a crashing share price in late 2022 and 2023. So what changed? Following a strategic review of the business in 2023, the company decided to put its successful Greek and Cypriot business Kostavolos up for sale. The rationale for this sale was to simplify their business and focus in on their core markets of the UK, Ireland and the Nordics. They agreed a sale and completed this in April 2024 to the tune of £175 million. This money was then used to immediately pay down some of their debt, which strengthened their balance sheet. In recent years, Currys has also tweaked their business model slightly, having shifted beyond one-off product sales towards higher margin services, including installation, protection plans, credit offerings, mobile subscriptions via their thriving ID mobile business, and repairs, which contribute to stickier customer relationships and recurring revenue streams. Recurring revenues are actually now 30% of total sales. ID Mobile is a particularly impressive growth driver, having grown from 1 million subscribers in 2019 to 2.2 million just 6 years later in 2025. Credit sales have also more than doubled since the early 2020s, from 0.5 billion to 1.1 billion of sales, with adoption rates in the UK and Ireland also doubling. Roughly 22% of total transactions now use a credit product. The Nordics, which makes up around 40% of the company now, have also been recovering very strongly after being hit especially hard during those challenging 2022-2023 years. In their recent peak Christmas and Black Friday trading update, the Nordics business was up 12% year on year, which was a better performance than the company was originally anticipating. On to the financials. One of the problems with Currys' investment case is that they are a low margin business and always have been. Should we have a repeat of the 2022-23 issues, margins could easily become negative and the company could become loss-making again, like it was in 2020 and 2023. The company is targeting an increased EBIT margin of at least 3% in the medium term, and brokers think they'll hit around 2.75% in 2028. While it's good to see that the company intends to strengthen their margins again, even at a 3% EBIT level, it'll still be low. The last time the company achieved these margins was in 2016 though, when the share price was around double what it is today. So that's worth bearing in mind. Debt is also not a problem anymore, as the company is in a net cash position with expected year-end net cash due to be above their medium-term £100 million goal. Revenue growth has also returned to the business with low single-digit growth expected for the next few years. Again, this isn't exciting, but we're considering this stock as a shorter-term recovery play rather than a forever hold. So with all of that in mind, is Currys still worth buying as a recovery play in early 2026? Full disclosure, I own a stake in Currys and have done for around a year now, so my stake has almost doubled. I will be continuing to hold for now while the business continues to report positive growth in both top and bottom line, continues to recover strongly in the Nordics, and it's market beating in the challenging UK retail sector. The PE ratio for 2027 is 11.7, which is still at the low end for companies of its type. AO World has a PE of 14.5, for example. Currys is also trading below its book value, i.e. the value of its assets minus its liabilities. In fact, its market cap is currently 21% below its book value. This, alongside its low PE ratio, implies that there may still be value to be had at this price. It's not a forever hold for me personally, and I will sell out once the company and share price have fully recovered. I'll be monitoring its slightly lackluster sales growth and be cognizant of the lower margins, but whilst the business continues to perform, I am a happy holder. The next scheduled trading update for the company is the 20th of May, so keep your eyes peeled for that one. And please remember to always do your own research and let me know your thoughts on Currys in the comments below.